Hello, everyone. Welcome to another episode of Upstream with RiverX. I'm your host, Kieran Berry, and today I'm joined by Marc from Global X. How are you?
Good, Kieran. Thank you so much for having me.
That's right. Lovely to have you here. Before we get into it today, I just have to go through our standard disclaimer. So anything that we discuss on this podcast today is general information in nature. Please don't consider anything that we discuss as personal advice. And if you need personal advice, please reach out to one of the financial advisors at RiverX or have a chat with your own financial advisor. But without further ado, thank you again for coming on.
My pleasure.
And I think for the benefit of our listeners, it'd be good if you could perhaps just give them a bit of a rundown of who you are, where you work and what you do.
Yeah, thanks, Kieran. My name is Marc Jocum. I'm a senior product and investment strategist at Global X ETFs. We're one of the premier ETF issuers here in the market. We're managing north of $14 billion in assets under management, 40 to 50 different ETFs. And my job essentially is to just help empower our team to get more content out there, product development. I work alongside our sales team a lot in meeting clients about how they can use ETFs in their portfolios. The ETF industry is growing. I mean, it's only 6% of the total managed funds market. So there still is plenty of room to grow. But, we're north of, $300 billion in assets under management. There's been a ton of flows that have come into ETFs overall. So I'm extremely bullish on the ETF industry. And for me, it's about empowering people. And I think at Global X, we're owned by a Korean asset manager in Mirai Asset Management. So we've got a really strong global backing. And more importantly, our whole vision is to really empower Australians to make better investing decisions, to give them the right tools, but also to be known for the uniqueness of our products, but also the quality of our products as well. So, we've been in the ETF industry for a long time. We came out with the first gold ETF back in 2000 and in the early 2000s, 2003. And we've been growing ever since, and it's great to be part of that journey.
And is that the GOLD?
GOLD. That was the OG. That was the first gold ETF in the world. It's now, a multi-billion-dollar fund. It's got, I think north of $5 billion in assets under management. And for people who want to collectively just hold gold in a very easy and transparent way, we've obviously seen over the last couple of months, probably people lining up to buy gold from physical bullion dealers. But, you can actually get it in a very easy package that you don't have to worry about storage costs. You don't have to worry about insurance, and you can trade it just on the stock market, just like any share. So for us, we're known for our commodities, but we also do things in a lot of thematics. We're building out our core suite. We have an income suite as well. So we're really trying to be more relevant to more Australians.
I actually own that ETF.
The gold ETF?
Yeah, in my SMSF. Yeah. So I use a lot of your products as a financial advisor and as an investor. And I must say that having worked in this industry since 2005, 2006 now, that it's definitely taken the Australian market by storm. It's definitely still a maturing market in Australia, but my take is that it's sort of far less sophisticated than our international peers. So the European and American markets definitely have a better depth and breadth. So it's sort of there for the taking.
Yeah, agreed. And I think that the penetration will start to happen here in Australia. I think you are seeing this migration from high cost to low cost. This migration from probably not so much all active to all index and all passive instruments, but people are really fee conscious with the rise of platforms and making investing tools more accessible. And on your point around different markets, I do think that the Australian market is a little bit more conservative than most other markets. And by that, I mean, if you look at the US as an example, there's now more ETFs over there than there are single stocks, right? So there's almost an ETF coming out almost every day. That's something new. Australia's a little bit different, where you see a lot of advisors really prioritize simplicity. And complexity is something that I've found hasn't really worked well. So one of my jobs as an investment strategist is to make very complex topics or complex investing tools as simple and easy to understand for, people like yourselves, Kieran, to make it easier for you to explain to your clients and to give them tools that they can help with their wealth management goals. So for me, I'm still incredibly bullish on the industry. We're growing at a rate of around about 35% per annum. So my view is by the time we get to the 2030s decade, this multi-billion-dollar industry is now going to be a multi-trillion-dollar industry. So it's fantastic to see. And, it's just now about the financial advice community just starting to embrace ETFs a bit more. And I still think there's a lot of cost savings that can happen in the market. We did some analysis that showed that if you get a lot of the managed funds converting into ETFs, or at least the money from managed funds, if they move into ETFs, it could save investors up to $4 billion in fees. So I do think people are going to be more fee conscious, and ETFs are the natural natural gate path for something like that.
We're doing that right now. So when I say we are doing it, as in my advisors are sort of actively looking for the ETF comparisons to the unlisted funds. So some examples that we would use in our portfolio are things like Hyperion.
Yes.
So HYGG.
Of course, yeah.
And then the other one is GCQ.
Yes.
GCQ has one at the moment.
Yep.
And I've met with a range of managers that are coming to market with their own. I think there are so many benefits associated with that, not just the cost, the daily pricing, no need for applications. It just makes it so much easier to be fluid. And if you want to take a position on the market, so say we think the market's overvalued right now, say we're seeing big shorts come out on things like AI, which is really topical right now. We can move out of that position intraday even, and then we've got our T2 settlement, but then we can take a position on gold,
100%,
or crypto, or whatever it might be within the portfolio.
Yeah, I think that's great, and you're starting to see more product proliferation in the ETF world. And one thing I have noticed is a lot of active managers coming into the ETF world to try capture on that distribution, because as you said, it's a better mousetrap. You know, it was almost like the MP3 player, and then the iPod came from that and just started to get a lot more interest. I see the ETF as being that evolution. And if you have a look at it, now that the ETF market, in terms of the number of funds, active funds are almost close to about 50% of the total market. But just because that they are launching as an ETF doesn't mean that flows are naturally going to come. I still feel the challenge for active managers is, one, performance, distribution, building a brand name, because you've still got these large incumbents who are known for being synonymous with ETFs, being mainly index-based funds. And I do think that the key is low cost. And you've seen a lot of ETFs come out in the low cost area. About 2/3 of flows are going into funds charging less than 25 basis points. So for active managers, I think you either need to be really shiny and really like high octane and active, or you got to be low cost and cheap. I have a feeling it's the ones in the middle that might struggle, and that's where you get a lot of these smart beta ETFs. You mentioned things like Hyperion, or taking an area or a factor like growth or value or quality. These are factors that you can actually package in an ETF and do it at a fraction of the cost. So, hats off to active managers who are coming into the ETF world, but it is going to be a challenge unless they can actually perform well or get effective distribution too. Distribution
matters. And I think back to your point of cost, that's something that is front of mind given the cost of living in Australia, particularly in Sydney where we are today. It's something that's front of mind for clients, and it's particularly for the advice community as well. So when we're dealing with a retail client, we have a statement of advice that sets out the costs, features, benefits and risks of any investment that they're going into. And we have to clearly articulate the layering of fees. And if we look at a listed ETF versus the unlisted fund, it's a world of difference.
Yeah, and it's not just a headline fee as well. Sometimes a lot of people don't think about the after-tax cost as well, because if there's inherent capital gains within a managed fund, well, guess who has to borne that? It's other investors. Whereas with an ETF, because a lot of the actual capital gains get streamed through some of the market makers, the actual capital gains event that occurs in an ETF doesn't happen as frequently as a managed fund. So while there's the headline management fee, which everyone has to be conscious of, there's also the underlying transactional costs, whether there's things like performance fees, but also think about the after-tax cost. And if there's a lot of high turnover in a portfolio, there's someone who has to bear that, and that's usually some of the other unit holders. So that's why I think the ETF is a more tax efficient and transparent mousetrap, and it's almost in the best interest of advisors if there's a like-for-like comparison between an unlisted active fund charging a lot of money and a low-cost index-based ETF. Well, the value proposition's there. So it's going to be hard to recommend the active fund over that index fund.
I think one other thing that people are mindful of is tracking errors on the ETFs as well, and they can vary depending on liquidity and who's overseeing that. How do you deal with tracking errors, or how does Global X deal with tracking errors?
So we have a portfolio management team, and their sole job, especially because we only have index-based ETFs at the moment, is to be as tight as possible to the underlying index. So whether that's things around liquidity management, the position sizes that they have, the foreign exchange hedging, using things like forwards or futures contracts, it's all about managing that tight tracking error, because what you're seeing, especially for a lot of our institutional clients who are increasingly using ETFs, they have performance benchmarks. And you're seeing that with the reform of your future, your super. People want to be as tight to the tracking error as much as possible. So our portfolio management team, every day, once they get new cash that comes into the portfolio, has to get actual files from our index providers and try and manage the exact positions that are in that underlying index. And if they can't do that, well, then that's an issue. So for us, it's very different when an active manager gets assessed for performance. It's all about how much alpha did you achieve. For us, it's about how close to the market beta we can get. And that's where you have very sophisticated trading tools that our portfolio management team do, not to try and identify alpha in a particular stock, but to try and get that tracking error as tight as possible. And if we can do that, that's a good outcome for our investors.
And then I guess that sort of segues into the next piece is the decision about which strategies you bring to market, because you mentioned costs, tracking errors, distribution. How is it that you come to the arrival of launching a particular strategy? Do you have a team that performs due diligence? How do you make that choice?
100%. So there's a lot of ways that we go around product development. We've launched 8 new products, or we're going to launch around about 8 new products this year. And that's quite a lot for a brand new ETF, for an ETF issuer. We get our inspiration from a few different areas, Kieran. Number one is speaking to clients. So we speak to people like yourselves or other businesses, financial advisors. What are the key challenges that you're facing at the moment? And how can we build a portfolio around that? A good example of something like that was our recently launched GARP ETF, Growth at a Reasonable Price. Right now, valuations here in Australia, they're trading above their 90th percentile. In the US, in the 20 times PE ratio above that. So people are a little bit concerned about valuations, but they don't want to reduce their growth posture. So for us, that was a really good feedback from clients to say we need a growth-orientated ETF, but paying attention to valuations. So that's where we launched the GARP ETF on the back of that. But then we've also got a product development team as well that we have a look at what are the trends in the market, what's happening overseas, where are some ways that we can innovate. We've got a very strong global presence as well. So for us, if we're seeing a lot of traction with our US-based team, a great example is our artificial intelligence ETF. It's now a $6 billion fund in the US. It's growing incredibly quickly. And we decided that we're going to leverage off that and launch that here in Australia. So that's our GXAI ETF. So you get a lot of different inspiration from both on the ground. We've got dedicated research, dedicated strategists. I think we produce some of the best research in the industry at the moment. We've got our sales team who are speaking to clients like yourself. And then we've got our overseas peers to help us with that. So it's a little bit of a combination of all of that built into one.
I laughed before because I own that one too.
GXAI?
Yes.
Yeah, no, it's a good fund because what I like about it is you could own pretty much the very similar valuation stocks as the S&P 500, but you're getting way better earnings growth potential. And a lot of people know that artificial intelligence is going to be here to stay. Now it's about how do you monetize that? Right now, it was more about this whole theoretical side of things. A lot of these companies are now moving to how can we actually build meaningful revenue, right? And if you have a look at companies like OpenAI, who have increased their revenue base by like tenfold, they're one of the fastest in terms of user adoption. People want to play that. And the great thing about an ETF is you can get a basket of 85 stocks that plays in this AI area with the maximum cap of 3% because we don't know who's going to win the AI race. And you can invest in an ETF. Not just that, but you've also got the next layer that can benefit, which is around the infrastructure of AI. So not just the software and the hardware players, but also think about the data centers, the people building the cooling systems and the actual energy behind it. I think that's that next second order impact because you're seeing a lot of these big tech companies spending hundreds of billions of dollars in CapEx. And it doesn't really matter like who actually is spending that, whether it's Apple, whether it's Microsoft, whether it's Google. There's going to be a key benefactor, and that's going to be these AI enablers, these AI platform providers, these AI energy providers. That's something I'm really bullish on, and you can access that with an ETF. So those are examples of 2 products we brought out to market.
And what about the crypto market? I've seen there's one called CRYP.
Yep.
Is that? I'm not sure if that's yours, but
no, that was another provider's product that was launched very early on. So that holds crypto mining companies. So if you want to invest in things like Coinbase and some of the underlying mining companies, so that's more like an equity-based strategy. But we were the first ETF issuer to come out with both a Bitcoin and Ethereum ETF back in 2022. That was, Kieran, in my opinion, the worst time to launch a crypto ETF because the market fell. I think the day we launched, the market fell like 10 or 15% that day. So really bad timing with launching it, but we were the first in Asia Pacific to launch a crypto ETF. And now the Bitcoin fund has more than $200 million in assets under management that trades under the ticker code EBTC, and our Ethereum is EETH. And what you've seen is the Australian crypto market just clicked over $1 billion. We saw the rise of people wanting to invest in crypto ETFs from the US early last year, where the first US Bitcoin ETF came out, and it's now one of the fastest growing ETF success stories ever in terms of new flows coming in. And we're still seeing flows coming into the crypto market. And I think you're going to see a lot more of this instead of people buying and trading cryptocurrencies. I think people are now positioning it in their portfolios, whether it's a 1 or 2% allocation for that diversification piece around potential debasement of currencies, particularly fiat currencies, but also that optionality. And I'm not sure if you're getting a lot of queries from clients being like, I don't know much about this rise of digital assets and Bitcoin, but I feel like it's going to be an important part. You're seeing a lot of institutions like endowment funds and pension funds now holding it on their balance sheets. So for people who want to access cryptocurrency, but don't want to go through an FTX saga or hold it on a different exchange that doesn't have any regulation or custody behind it, an ETF is a very, very natural way because they can hold it in a custodian. You've got access to your liquidity, like you said. It's in a managed investment scheme structure, so it is protected. And we're seeing consistent flows. I think there's been at least 400 to 500 million that have come into crypto ETFs so far over the past year. So still very bullish in that industry.
Yeah, I have access to a range of platforms to buy direct if I want.
Yeah.
But there have been so many platforms that have been compromised over the years that I could never really get comfortable with putting a lot into it. Whereas with an ETF, whether it's through Global X or any other provider, you'd assume that they would have insurance policies in place. You'd assume that they have cold storage in place. They have all the proper measures in place to protect an investor.
Yeah.
And it's almost the equivalent of, you're seeing people line up in Martin Place to buy the bullion, to put it in their storage, and they're paying a fee. Well, that's kind of like how I view buying it through an ETF.
It's convenience. That's what it's about. Like, you don't have to worry about protection. If you buy a Bitcoin yourself, where do you keep your password? But where do you keep it? I mean, there's so many stories about people who can't actually access their actual hotkey because they don't know their password. Same on the gold side. People don't need to pay these expensive storage costs or insurance fees. It can be held in a vault in London for you. And the most important thing about that, Kieran, is let's say you do want to redeem that gold, or you do want to redeem your Bitcoin into your own wallet, into your own storage. You can do that with an ETF. So when you're buying a gold ETF or whether you're buying crypto ETF, ask them, can I redeem it for actual physical bullion or physical Bitcoin? We've had a few of our clients do that. And whilst I don't really understand why you want to do that, because again, if you're a financial advisor, portfolio rebalancing is so easy when it comes to, gold's gone through this massive parabolic rise, which shouldn't really happen for something like gold. So we've noticed a few of our clients actually selling gold to rebalance into other areas that haven't done as well. Imagine that, doing that with a physical gold bullion to be like, well, how do I rebalance my portfolio? Same with Bitcoin. So a word to a lot of people out there potentially watching this, if you're using a Bitcoin or gold ETF, ask them about the physical redeemability and if that's possible.
And how do you deal with the fact that a lot of people would be staking? So you get staking for additional yields on the assets. I would imagine that's why people would want the physical if they were redeeming it themselves. Is that a consideration when you're launching these ETFs, or is that's a little bit?
Look, I think that's a very new industry, very nascent. We're still getting people who are trying to understand how crypto mechanics work, but people want to monetize any type of asset to provide some sort of yield. And you've seen that with the likes of things like covered calls. Right? So a lot of people see a lot of volatility in the market. They see a lot of equities that might trend sideways or trend downwards. How can they monetize that? You can actually sell call options on top of that to generate a little bit of yield from the premiums. I think that's a really interesting strategy, particularly in the Australian market around Australian covered calls, which we've got the only index ETF in that space in AYLD. And then to your point, Kieran, I think that's going to be a next phase that we're starting to see in the US. The issue is around regulation around that. So whilst you can do that currently with a few of the crypto brokers out there, you're starting to see a few of these Bitcoin and Ethereum staking ETFs that are starting to launch overseas. Whether that will come to the Australian market, maybe. I'm not 100% sure that the market's ready for it just yet, but I do know that Aussies love income. And if they can get income or a consistent yield, whether it's on a quarterly basis or a monthly basis, or even sometimes you're seeing weekly bases coming out, they're going to find a way to do that. So that's a great thing about innovation and ETFs is you can package these ideas that you spoke about in an ETF wrapper that you or any person in Australia can just buy on the exchange.
That's why I asked the question, because most Australian investors have an affinity with income, and that's because of their love affair with franking credits, especially within SMSFs. You got self-funded retirees, and I'm not suggesting crypto is the right thing for self-funded retirees, but normally when they're investing in an asset class, that is a consideration for them, the income piece.
So. 100%. And even if you get, very tried and tested investors like Warren Buffett, he looks at areas that have meaningful cash flows. And when you're talking about things like Bitcoin, when you're talking about things like gold, it's essentially an asset that sits there and doesn't produce any cash flow.
Mm-hmm.
So a lot of Australian investors might be, how can I actually get some cash flow out of a non-yield producing asset like that? And then on your point around income, I think income is here to stay. Especially now in Australia, it's one of the very few times or rare times that we've seen the dividend yield on the Australian market, the bond yield and term deposits all below that 4% mark. And now we've seen, the latest inflation print, the RBA saying that inflation might be a little bit higher and not return to that midpoint up until mid or late 2027. I feel like a lot of people are really going to need income. And you can get that through ETFs. We're seeing a lot of traction in things like credit or fixed income.
Oh, yeah.
It's kind of around about 20% of the flows in terms of year-to-date flows. And we've seen over the last 5 months at least $300 million per month going into these credit ETFs. So these are things where you're owning things like subordinated debt, senior bonds, even hybrid securities. And that's going to be phased out over the next few years up until 2032. We're seeing a lot of interest in things like that. So I still feel income is front of mind for investors, and a great way to get that is through exchange traded funds.
So if I wind back to when I started River 2 years ago, we went pretty heavy into the unlisted private credit space. And that was what a lot of the podcasts were initially about. But now we've sort of changed that tune, and we're maintaining exposure there, but new exposure, we're looking at listed debt. And where we're doing that is in sub debt, what you're seeing. But we're seeing a lot of the capital notes come to market, like the Stonepeak infrastructure notes recently. I know MA Financial had one earlier this year. They might have another one before the end of the year. But I think that's where the natural flow of capital is. Is that, you said 20% is going into that space. I guess what I'm saying is that people are looking to de-risk portfolios, particularly from a liquidity aspect. So they're saying, well, the unlisted private credit funds can put up the gates at any moment. Well, not at any moment, but if you do see something go wrong, that's typically what will happen. Whereas in this environment, I've got daily pricing. So is that one of your biggest areas for growth at the moment, listed debt?
Definitely. And you're starting to see a lot more regulation happen in that space as well. We've seen ASIC now come in and start to look at the private credit industry around disclosures, around fee gouging and things like that. So I do still feel private credit has a room in people's portfolios, but in terms of being able to access it in a daily vehicle that's transparent, I still don't understand how an unlisted vehicle can actually be can kind of take that form in a liquid ETF. I think some things are better left unlisted. And it can still have a part in portfolios, don't get me wrong, but to prevent people, and I've heard a lot of I've heard some great stories about private credit, but I've also heard some shockers. So I think doing a lot of due diligence across these private credit managers is going to be important. But we found where a lot of advisors want to blend your private credit managers with a transparent and liquid debt vehicle that's in a listed structure that has that liquidity profile. So if you're talking about, funds that are yielding in the low double digits, which is pretty high, you got to ask, well, what kind of risk are they taking? And when you've got something like our bank ETF, which invests in a lot of the banking debt side, it's currently got a running yield of around 5.5%. So if you kind of use a bit of a barbell approach with both of it, you get a really nice liquidity profile, a bit more of a monthly income, and you can get that that idea that if you do want to actually look at under the hood what's in it, we disclose the holdings every day.
Yeah, and I think the other thing I would say to that is you do have to be very selective in that unlisted and listed debt market. There's a lot of new players in the market, and so we're sort of not really going towards those. We're looking at the bigger, more established funds that might be bringing a listed comparable to market. That kind of makes sense. Like Stonepeak's $115 billion fund. MA, been around, credible name. But you've got all these smaller ones coming to market, and we're kind of just saying, well, it's a bit too new, a little bit too hairy for us to be looking at.
It's kind of this Darwinistic approach. I think that there will be some sort of credit crunch. I don't know what it is, to be honest, but private credit's only been around for the last 15 years and hasn't been through that just yet. So I do think that there's a saying that, when the tide goes out, we'll see who's swimming naked. I think that a lot of the really high quality private credit managers who are managing their LVR ratios, their actual underlying books, will survive and continue to, pile in more money into that. But it's the ones that I am worried about, the smaller ones, the more risky ones, perhaps the ones that are a bit more concentrated on a particular industry and one that doesn't have an as diverse book, because to look under the hood is very challenging. And that's why I encourage a lot of these private credit managers to, and some of them are doing it very well. You know what I mean? They're doing it very well in terms of disclosures, but you're now seeing the regulator get behind it, which to me says that there's going to be more that's coming.
Yeah, I think so. And look, the regulator is sort of all over the private credit space. I agree with your point. If it's got double digits in front of it, it's probably carrying a bit of risk and
Agreed.
and more than what you'd be comfortable with if you knew what it was.
Exactly.
It's normally, mezz finance or construction, especially if you're talking about like first mortgage type funds, or if you're looking at corporate credit or infrastructure and it's got those type of numbers in front of it, you really have to question the quality of the underlying asset, but more importantly, the valuation. The
valuation, 100%.
And the valuation is the killer. So
100%.
We've seen a couple of funds where they've locked up and it's actually 100% OVR instead of 60% of what's on the label, or they have a post-completion LVR. Yes. And that's the other sneaky one that a few funds have done. So it's like, oh, look, we're only 65%. Was like, no, you're 100.
Yeah.
Yeah, it's because as at today, what's the value today?
Exactly. Yeah. And I think for a lot of people, they want to kind of mimic what was happening with, people who are trying to do things like the Future Fund or to do with the Yale endowment funds, that there's this whole idea of this new alternatives bucket. The 60-40 portfolio, in my opinion, is moving to a 60-20-20, where that 20%, the 40% that was traditionally just fixed income or just bonds is now, well, how do we get bond-like volatility with more income? Yep. And you're starting to see private credit do that. You're seeing things like infrastructure, real assets. I think that's that next layer. For me, I would just be prioritizing liquidity, because it's not until there's a rush for the floodgates then you realize, well, who are going to be the people holding the bag. And when you're blending these alternatives, I do think having unlisted forms part of the portfolio, but liquid alts, commodities, gold, digital assets. There's a whole range of these different layers that you can now get within an ETF. I feel that blends and that will fit quite nicely in that 60-20-20 split.
Yeah, our portfolios are more like 50% traditional and 50% alternatives. Yep. But in the traditional bucket, you got fixed income and equities, and then alternatives is your private equity, venture hedge, private credit, commercial real estate, liquid alts, and that kind of sits in that. So it's really well blended there. But we do look for things that have a liquidity profile, or sort of near-term liquidity profile, because you just don't have options.
Exactly.
And if things go poorly in an illiquid, unlisted asset, you don't have much room to move.
Yeah.
It's actually not up to you. So from the day the capital is deployed, you're beholden to the investment and the manager to achieve the outcome.
Exactly. And I also do worry as well, Kieran, around too much dry powder chasing too few assets as well. Yeah. So, I mean, David Swenson, with the whole Yale model, he kind of popularized this idea that all these large endowment funds should be investing in private equity, should be investing in private debt. And now, because it's come to the masses in terms of very easy wholesale funds, some ETFs are trying to do it. I still don't know how it's going to work. I actually am a bit worried about too much money chasing too fewer deals, where if you have in the bond market or the equity market, these are very, very liquid markets that there's tons of turnover going every day. So if you're trying to get in and out, think about that implied liquidity, not just the headline liquidity, the liquidity of the underlying as well.
Yeah. And I think that's sort of brings me to my next question. You mentioned that is it number one private listed debt in terms of flow at the moment? Is that
number one would still be going into broad-based funds. I'd say a lot is going into low-cost global equities and Australian equities overall. Where we are seeing a bit more traction is in this idea of smart beta that I spoke about before, these factor-based ETFs. They now make up around about 14 to 15% of the ETF market. To give you some context, around about 10 years ago, it was only 4%. Yep. So this idea of using equities to mimic what active managers are doing, but are doing it in a low-cost form, like our GARP strategy, that's been really interesting. Regional diversification is one that's definitely come up. So last year, around about, I'd say, about a quarter of the global equity flows, or at least a third of it, was going to the US. Now we're seeing a little bit more going into different areas. Last month was the best month ever for Japanese equity ETFs. So people are thinking, well, is there a turnaround story happening in Japan? The deflation story is over. There's a lot of shareholder activism, a lot of corporate governance happening in Japan. Europe is another interesting one, particularly around defense over there. There's obviously been a flood of money that's come into that area too. Again, the earnings profile isn't as big as probably the US. And whilst I do think US exceptionalism and the AI narrative is still intact, this idea that innovation is borderless is incredibly important to us. And what I'm starting to see a bit more in ETF flows as well, China is back on track. We were chatting a little bit offline before that this whole idea of this massive capex cycle that's happening in the US, China is beginning that area as well. And China is a very planned economy. They had this made in 2025 China plan. So I think for people who want to access global equities, it's not just a US story. US is still going to be an incredible part of the portfolio, but in our own side, we're seeing a lot more inflows into our China Tech ETF, which trades under the ticker code DRGN. It's one of the quickest thematic ETFs to grow to 50 million in assets. And we're just starting to see a bit more regional diversification within things like Japan, things like Europe. But I still think if you want growth, particularly around earnings growth, the US is going to be pretty hard to beat.
Yeah, and I think that sort of strategy came to light at the beginning of the year because we had the anti-US trade where the tariff tantrum kicked off. I think that's what they were calling it.
Yep.
But then everyone was saying, well, we're willing to bet on Chinese chip makers. So how do we get exposure to that? And also the valuations in the US, in Europe, are far more compelling than the US. And that was something that we're seeing some interest in from our clients as well. I would say, so if you had to call out your top 5 sort of areas where you're seeing the most inflows, you've just said the equity, you've got the active managers, sort of your beta strategy you mentioned, and credit. What are some others that we're seeing some good flow to?
Commodities has been the best flowing for us at the moment. So year to date, in terms of the broader commodity ETFs have taken in $2 billion so far. That's the best by a country mile. So I think we talked a little bit before about the massive idea of investing in gold. Gold went through this crazy parabolic rise, which doesn't happen for an asset like that. So I think what we're seeing now is a little bit of consolidation, but the structural story of gold or commodities is still intact. You're seeing central bank buying, especially on the dips, the rise of Western investors coming back, people trying to hedge against Fed independence around the US fiscal deficit. I feel that gold, and we're seeing a lot of projections and analyst projections, that gold could hit $5,000 a ton by the end of next year. So it might be a little bit choppy and probably see some consolidation around that 3,900 mark, but the long-term thesis is still intact. So that's one area I would say is commodities. We mentioned around digital assets, we're still seeing flows, fixed income, another growing area. And in the thematic side, I'd say most of the thematic flows, and thematics only account for about 4% of the ETF market. But in the thematic area where we're seeing people blend with their existing strategies is all around technology. So AI, cybersecurity, and then around defense technology as well. I think those are the 2 themes that are continuing to carry a lot of the broader market, whereas other areas, whether it be EVs or some parts of the clean energy market, have also suffered. That being said, things like uranium or copper that are powering this AI revolution is seeing really strong demand. So our Y ETF that invests in copper miners, or our Atom ETF that invests in the uranium and nuclear value chain, is still seeing a lot of interest overall. So between those areas, I'd say those are some of the key focuses for us. And I mentioned before the regional diversification piece. So Europe, China, also seeing strong flows there.
Yeah, and I think the future is pretty bright for providers like Global X because you're really well positioned to capture the market. I understand it's relatively low cost to bring an ETF to market in terms of the initial. I know you got product development, marketing, that piece, but in actually getting it listed, it's not too much of an expensive exercise.
Yeah,
from what I understand.
We do have quite a lot of. There's still costs involved, So I wish we could charge ETFs for free, but we can't because we're trying to make a profitable business. But there are some costs, particularly here in Australia, where you have to pay things like your custodian, the share registries. There's a lot of setup costs around getting an ETF to market. When we're listing on the ASX or CBO, there's still listing fees. And also, people don't forget, but when you license an index, you have to pay the indexer fee. So whether that's a fixed fee or whether you pay them a variable fee, let's say we're tracking, the Euro Stocks 50, or we're tracking other indices like the Nifty 50 for Indian equities, you still have to pay these index a fee. So we, as a business, have to be we have to try and at least maintain some sort of profitability. So we do a lot of break-even analysis to work out what's the fee we could charge on an ETF. And normally it depends on that, but a lot of ETFs need to at least get to at least 50 million, maybe 100 million to be profitable. That being said, we've also bought a low-cost ETF to the market in A300, which tracks the largest 300 equities in Australia. That's the lowest cost in the market at 4 basis points. So for us, that might take a little bit longer and not at 50 or 100 million to break even. So whilst it is cost effective to bring an ETF to market, there's still underlying pipeline and engineering costs that we need to pay.
And in terms of, I guess, our clients and investors generally who want to learn about Global X, do you have a team of people that deal with investors on a direct basis, or do you only deal with advisors? Like how does that work?
No. So the great thing about the ETF market, Kieran, is that it's very diverse. So I'd say around about 2/3 of the market is controlled by financial advisors. They control most of the wealth. They manage a lot of clients. So a lot of our interactions is probably more with financial advisors or brokers, but there's still a big part of the market, call it 20-25%, that is retail investors. So for us, we've got a direct team that people can call, people can email. I'm on the road a lot doing things, whether it's like something like this or giving presentations at big conferences where people who are still just learning about ETFs can actually go to. And we can explain things like how creation and redemptions work in ETFs. We can go a little bit more sophisticated and talk about actual implementing strategies. I feel there's a wide range of research that we put out, both in terms of sophisticated knowledge. And I mean, I came from a investment banking background and I was used to producing, really high quality pieces of research that I've loved continuing, but also just evergreen content. People learning about basics of investing, understanding about things like dollar cost averaging, managing a risk, portfolio construction. The best thing I would say for people is to jump to our website, globalxetfs.com.au. We've got a range of insights and content on there. Reach out to one of our teams. So we've got an info line you can call, or if you're on the financial advisor side, we have offices all over Australia in WA, Adelaide, Melbourne, and Sydney, and in Queensland as well. Reach out to one of our reps and we can have a conversation with you. We are quite innovative as well, and there's been times where we have built ETFs for particular clients. So you can definitely, if there's ideas around product development and things like that, we're very, very much open to that.
That's great. Yeah, because what I'm thinking is a lot of people feel that the bigger institutions or the bigger fund managers are just inaccessible to them. And certainly advisors don't feel that way because we have them coming through our offices all the time. But when it comes to the individual investor, it's good for them to know that they can reach out to you directly.
Definitely. And I feel with a lot of the issuers coming to market, a lot of them do come from that traditional, large American or Euro bank side. So it might be hard to actually have a direct contact. We put a lot of effort into creating a local team over here. So right now, our office is close to 60 people overall here in Australia, which might be a little bit small, but we have broad base around Australia. And even though we're owned by a Korean asset manager, we have full autonomy of what we're doing here in Australia. We speak to our US offices, we speak to our European offices, we speak to our Latin America offices, but here we're an Australian-based company in terms of delivering outcomes for our clients. So people shouldn't feel nervous to reach out to us. Like, we're here to help. I'm here to help. I'm very passionate about financial literacy, more for direct investors. So like my wife, as an example, she has no idea about investing. So I've started to teach her a little bit more about the benefit of putting your money into ETFs. But then also we deal with some pretty sophisticated clients who are trying to use things like liquid alternatives or looking for liquidity sleeves or things like that and how they can use ETFs. So that's the great thing I love about this multifaceted industry. ETFs can be used for so many different purposes for a range of different clients.
And I think it's timely, just given what we're seeing all over the press, like people lining up at ABC Bullion. You've got Michael Burry loading up an 80% of his portfolio shorting AI. So it's really timely that we have this chat because people need to be aware that there are alternatives in the market to the unlisted. I personally have a preference towards the listed, even though we have quite a bit of unlisted within our book. And that's just for the very reasons we mentioned. It's your security, liquidity, diversification.
Yeah. And on that, I mean, the great thing about ETFs now is, let's say you want to take a view like Michael Berry and express a short position on the market or even a long position on the market. There are ETFs that are for that. And that way you don't have to worry about trading in the options market yourself. So we've got our leveraged NASDAQ and short NASDAQ fund, which I don't recommend in terms of long-term holds. But if people are very bullish on, let's say, tech and innovation, LNAS is a great way to play it from a short-term perspective. Same thing if you want to take a short position, SNAS. We spoke about gold as well. But then around this whole AI narrative, like, how do you actually invest in AI? OpenAI is a private company. You can't actually invest in that. But now you're starting to see a lot of companies take stake in OpenAI and you can access those equities through an ETF. And whilst you do have a lot of these, and I mean, companies are staying private for longer, is something I have noticed, probably a trend that will continue. But if you're looking to actually invest in a particular theme or break that sector bias, I think ETFs are a very natural avenue for something like that.
Yeah, we did get shown a secondary in the OpenAI.
Oh, yeah.
So obviously that's back to the unlisted.
Yes.
And I'm hearing that it's a $1 trillion IPO.
Oh yeah, it'll be a multi-trip. It's wild just how much, and you're seeing it across not just in the AI industry. We've seen the Australian market darling Canva potentially listing over in the US after Figma recently listed, and people want to get access to the ground quite early. And I think having equity in a business early on is important, but not everyone has access to that. So you mentioned, Kieran, yourself, and your businesses might get access to that, but a lot of average investors out there just have no idea how to actually do this. So that's where the ETF breaks down that barrier.
Yeah, and also it's really not appropriate for most of them to do it as well, because if you've got your it just depends on your stage in life and liquidity requirements, but it's probably only suitable for a very small percentage of the market.
Yeah, and that's where you have professionals like yourself who deem what's appropriate for a client. So I think it's very important to speak to your wealth management professional, your financial professional, and some places can offer you that. And I think that's the really big thing that a lot of these financial advisors or wealth managers are now moving away from being stock pickers into really trying to access whether it's exclusive deals on the wholesale side or really thinking about other things like insurance planning, estate planning, and they leaving the investment management to the ETF providers. Yeah. And you can focus more on the asset allocation, getting the risk profile right, and not worried about picking stocks, because the harsh reality is 67% of stocks underperform the market, and half of the stocks out there actually have a negative return for investors. Yeah. So because only 4 to 6% of most of the stocks generate, 4 to 6% of stocks have generated pretty much all the outperformance in the share market, being able to identify those are incredibly hard. So that's where ETFs are actually making people's jobs from a financial professionals' perspective a lot easier.
Yeah, I worked at a firm that was sort of had more of an affinity with stock picking. I found that when I transitioned and focused more on holistic advice, I didn't want to be doing that. Yeah, there was a saying we had there when they were stock picking: if you try and pick bottoms, you get smelly fingers. Yeah, and that is very true. And that's because it's very difficult to outperform the market on a long-term basis, even if you're a great fund manager. There are sort of only few and far between in the Australian market that can do it. Yeah. And it's one of those things where, as an individual advisor, most of your job is relationship management with the client and helping them solve for a purpose, whether it's buying a new home or whatever their lifestyle goal is. It's not really there to show that you're some sort of stock market genius. I would say that of the top advisors that I'm friends with, and we often share ideas about how we service our clients, I would say that the investment piece is really 10 to 20% of what we do with them. Yep. And I would say that the investment piece for the best advisors isn't a deciding factor for their clients. Yeah, structuring them in the right way, unlocking equity, getting them the right structure and solutions at the net outcome, which you mentioned before is important for your funds, is really the key to success.
And on that, some people are good at identifying outperforming fund managers. My only issue with that is, whilst there are a fraction of a percentage that actually can outperform, only about 1 to 2% can do it over a sustained period. So as a financial advisor's job, not only do you have to find the outperforming fund, but you have to consistently do that over time, which is incredibly challenging to do. And I feel that for a lot of advisors, they also want to have better conversations with their clients. And I use this term conversation alpha. It might not necessarily be an alpha in performance, but when you can bring to them things like invest in AI through something like GXAI, or you can invest in gold, or a lot of these other non-vanilla type areas, that actually brings a bit of a connection between the financial advisor and the client themselves. And then our job as an ETF issuer is to provide you, Kieran, and your team with information, research, stock stories. How does the index methodology work? And if you can explain that very succinctly and simply to your clients, well, then we're doing a benefit to both businesses. The advisor feels like they being able to offer something that's quite new and quite different to a traditional side of things. The end client actually gets a little bit of time to invest, not just their core money, but let's say there's this idea of core and explore. If they are having a little bit of fun with the 10 to 20% of their portfolio by investing in these latest edge themes that they know have a high volatility profile, and it prevents them from touching that other 80%, I think that's naturally a psychological but behavioral hack right there. So for us, it's a bit of a balancing act, a bit of a barbell approach. But yeah, agreed. The structuring, the asset allocation, the tax implications, those far outweigh the stock picking areas. And I think you're starting to see a lot more financial advisors move in that direction.
Definitely. Well, mate, thank you so much. That was great to learn a bit more about Global X and also to share it with our audience. Is there anything you want to say in closing to the team?
No, Kieran, I think it was a really good chat. Like I said, I still feel that the ETF market here in Australia is relatively small. It is growing. And if I had to leave people with some sort of parting words, I would say focus on the things you can control. Focus on keeping your costs low, making sure you do have that diversification piece, but also being an optimist. So I have this idea that, you save like a pessimist, but you invest like an optimist. Yeah. And whilst there is a lot of doom and gloom out there, every morning I wake up to see what has Trump said, what's happening with trade wars. There's a lot of concern now around this AI bubble. There's even a concern around an ETF bubble, which I don't really understand. In my view, a lot of it is fear-mongering, and I want to invest based on innovation and optimism. Yep. I think if I'm betting on capitalism and things getting better, it's incredibly powerful, and you can actually monetize that with an ETF. So whilst there's a lot of headlines out there, tune out that noise, back yourself, speak to a financial professional like yourself, and really harness the power of ETFs to get better tax outcomes, better liquidity outcomes, but overall just better income and better investing outcomes so that you can be on your wealth management journey.
Brilliant. Thank you for joining us, and thank you for everyone for tuning in.